All right. Well, good afternoon, everybody. This is Neil Doherty from SRM, and we're going to go ahead and get started with the cryptocurrency webinar. So just wanted to say thank you for joining the team at SRM today. We're delighted to have you with us for this installment in our series on cryptocurrency and digital assets trends. And today we'll be taking a deep dive into the latest regulations on digital assets and crypto at the state, federal, and international levels. My name is Neil Doherty. I'm the VP of Marketing and Communications here at SRM. I'll be assisting our presenters during the session. And please, if you can, use the Q&A feature here in Zoom to send us questions as they arise today. We'll be taking a look at those. We'll capture them and call them out at the end of our session. And as always, we're recording the webinar and we'll share it with you and any registrants who may have missed the live session by email as a follow-up. So now that the main housekeeping stuff is out of the way, I just want to introduce our presenters today. First, we have Larry Pruss, who you will recognize if you've joined us previously. He's here with us today. Larry's the managing director of our digital assets practice, advising financial institutions on strategies to turn digital currencies from a threat to an opportunity, as we say. Larry's a featured speaker on digital assets, spent a lot of time educating board members and other influencers in the financial services industry on this topic. And also with us today is Patty Webbles. Patty is the SVP of Client Development at SRM, and she is a certified cryptocurrency expert through the Blockchain Council. Patty meets regularly with FI leaders, curious audiences throughout the country, educating them on crypto, on digital assets technology. So awesome to have Patty here with us today. And you'll also hear from SRM's Jesse McGannon, who's with us. Jesse's the VP of our digital assets advisory practice as well. He's working on delivery for client projects, collaborates on strategies to integrate digital asset solutions into existing tech stacks. So great to have Jesse with us today as well. So we're really looking forward to this, and I'm going to pass it over to Patty, who can get us started on today's topic. Go ahead, Patty.
Awesome. Thank you, Neil, for kicking us off. And I do want to just do a quick shout out and thank you to our marketing team for all they do to make these webinars happen. But thank you all on behalf of the SRM Digital Advisory Team. We want to thank you all for your time and interest in this topic. Today, you're going to hear from all three of us, as we saw, Larry, Jesse, and myself, on this regulatory environment from state, federal, and international levels, as well as some compliance information to tie it all together. But before we get too far, of course, we have our infamous disclaimer. All of the information that we are covering today is for educational purposes only. None of us claim to be legal advisors, tax advisors, or financial advisors, not even experts. And so you'll still want to check with your own regulatory and compliance team and experts, your regulators, and verify through your proper legal channels. We have just an hour, so we'll be hitting just the highlights in these particular regulatory areas. Not only do we not have enough time to go through these areas too deeply, but unfortunately, we also want to acknowledge that the space is evolving very rapidly and information can change on a daily basis. So please continue to monitor the space with your team and continue to facilitate the conversations. Just a word from our sponsor, Strategic Resource Management. For those of you not familiar with SRM, we are an international consulting and advisory firm for financial institutions, especially in the areas of the third-party relationships. Many of you may know that SRM is celebrating our 30th year anniversary. We've built a strong reputation in the financial industry for our diverse and experienced team around the world, benchmark data to help financial institutions look for ways to reduce costs, increase income opportunities, and update process efficiencies. Areas of focus include payments, digital banking, core banking, and other digital mapping strategies. We also assist with advisory services around merger and acquisitions, strategic planning, operational improvement, and change management. And of course, our advisory services around digital assets such as crypto and distributed ledger technology. All right, so all that being said, Larry, would you like to kick us off with some setting the stage on the different regulatory areas that we're about to cover?
Sure, Patty, and recognize, of course, we have people both from kind of banks and credit unions as well as from the crypto industry. So some of this may be what you're already familiar with, but we're going to talk about obviously regulation, which Congress makes the laws. Obviously, enforcement is carried out by agencies like FinCEN, OFAC, OCC, SEC, etc. And then compliance is obviously incumbent on financial institutions and digital asset firms. So a little bit of background before we talk about regulation enforcement. It's worth considering, how does one acquire digital assets? Well, obviously, you can do peer-to-peer transfers of digital assets. You can acquire digital assets through mining, like Bitcoin, through airdrops, which are kind of like free crypto. Often, crypto providers will offer that to incent people for various things. You can create your own tokens, which we would call minting. There are crypto ATMs and there are exchanges. And then in terms of how these things are funded, you can do cash, certainly like peer-to-peer. I could show up at a local coffee shop and meet someone and agree to give them cash for digital assets. You could transfer it into my wallet. Wire transfers, ACH, and credit and debit. And those are all things that obviously people would be familiar with if you've moved money to the crypto exchanges. And so today, kind of enforcement and regulation really focuses on the on and off ramps. Cash purchases of crypto or P2P payments really create the biggest tracking headaches from a compliance standpoint. That's why when we talk about digital asset solutions for financial institutions, they tend to be closed loop systems, kind of buy, sell, and hold, but that's going to change over time. Not knowing counterparties in a transaction can be problematic. That's very common in the decentralized finance space. But let's say I was purchasing something with cryptocurrency, I could inadvertently be purchasing from someone in a sanctioned country and be not complying with treasury rules. So that could be a problem. Compliance generally depends on where, obviously, financial institution or digital asset solution providers does business. And then, regulation isn't consistent worldwide, which causes some regulatory arbitrage. One additional challenge is there's no real uniform definition of cryptocurrency. You'll hear me and all of us use kind of cryptocurrency, digital assets, exchange, virtual currency, digital tokens, crypto assets, or simply crypto kind of interchangeably. And that's a problem when it comes to regulation as well. So first, I'm going to start with what are the requirements for digital asset firms. So we're going to talk about digital asset firms. We're going to talk about financial institutions and some of the overlap, because a lot of financial institutions right now are considering getting into the digital asset space, and a lot of them are doing them through third-party providers or partnerships. And so you have to be, cognizant of those third-party providers. What are their requirements, as well as what are your requirements? So requirements for digital asset firms, really FinCEN registration, OFAC compliant, BSA, AML requirements, same things typical for financial institutions. That includes filing SARs and CTRs, state money transfer licensing, sometimes surety bonds, and other requirements. So I mentioned money service business regulation. So most digital assets fall under the federal or state definitions of MSB, or money service businesses. While depending on the flow of funds, who holds custody, and some narrow exemptions, really most digital assets get licensed for all the states they do business in addition to registering with the federal government. Having a designation such as MSB means you must comply with Bank Secrecy Act, AML, OFAC rules, again, similar to what banks and credit unions. And again, these are for digital asset providers. So we're going to talk a little bit about state regulations. So I'm going to hand it back to Patty. Then we're going to talk about federal regulations, and we're going to talk about from an international level, and then just wrap it up with some takeaways. So Patty, back to you.
All right, thanks, Larry. So you'll hear a little bit of overlap as we move through the different sections, especially when it comes to definitions. And while many states regulate the virtual currency under existing money transmitter rules, specific cryptocurrency laws and regulations do vary state by state. There are a few challenges that we see right now. By now, most states have actually issued some sort of guidance, interim guidance, opinion letters, or other information on where they stand from a state regulatory framework. There is a bit of range to these positions provided by the states in regards to virtual currency and blockchain and distributed ledger technology. So again, from a definition standpoint, Larry talked about it a little bit already. What defines the sale of a cryptocurrency? Is it certain amounts? Is it a new coin versus token to token? And of course, the ongoing definitions between commodities and securities. Another definition that seems to be in flux is whether cryptocurrencies or virtual currency is considered money under the existing state laws. And so there's some debate over also the definition of the store of value. So all these different areas are what we continue to see evolve. The Federal Reserve and the IRS do not currently view Bitcoin and other cryptocurrencies as real currencies or tender, but this is not the case in some states, however. So again, we just sort of keep in mind that we're all still learning about this new technology. We're getting up to speed and really making sure that the rules that we go along, the regulations from a state or otherwise, will continue to shift as we learn more. We all learn more, and so it will continue to be edited in this space as well. Another challenge, I'm on the previous slide still there, Larry. Another challenge that we see is, does the movement of virtual assets or digital asset firms get trapped under MSB, which Larry talked about here just a minute ago. So again, how it reads now, the sale of cryptocurrency is generally only regulated if the sale constitutes the sale of a security under the state or federal law, or if it's an investment under the state law, or otherwise performed if the person is a financial service enterprise under the federal law. So the term money transmission services, or also what we hear as MSB, is generally defined to mean the acceptance of currency, funds, or other value of substitutes for currency from one person and the transmission of that currency to another person or to a location. So those are some framework to it. So our team has actually reviewed all the states in terms of the regulatory standpoint, state by state. Almost all states have specific regulations that capture cryptocurrency firms or firms dealing with digital assets under the MSB laws. So that means they will require licensing and or transmitter bond at that state level. So this is important for financial institutions because we know when you're evaluating these third-party providers, you need to make sure that they are licensed in the states that you're doing business in. And some states do not even allow this, like Hawaii. The most common default verbiage is around inclusivity, sometimes exclusivity of digital assets in the existing MTL requirements and laws, which does provide some regulatory framework. So when you go down the list, there's really no uniformity on these approaches. It's sort of patchwork right now when we look from state to state. Today, some states require just the money transfer licenses, while others define such currencies as equal to a fiat money and require both digital asset businesses to obtain an MTL and a money transmitter bond. There are states like Montana, in Indiana, South Carolina, a little bit in Texas, where no MTL requirements are on their definitions. So for now, digital asset companies are definitely challenged with needing to be licensed in various states with different rules, in addition to the federal regulations that are coming, international regulations, of course, as well, and they will all likely have their variances. So again, some of those different challenges that we're seeing from a state level. While the federal agencies have been lagging behind a bit to work on organizing some sort of unified regulatory front, Larry's going to talk about that next. Most agree that the challenge is that they will anything that the government does, will that contradict any guidance that's already been laid out at the state level? So time will tell on that. In the meantime, some specific states that we'll cover today, over the last 8 to 9 years, there have been a few states who have pioneered the path to early versions of regulatory framework for the digital asset and the crypto space, such as applying anti-money laundering requirements or digital service providers. So some of the honorable mentions that we're talking about today, first, New York, and not always seen as the most pro-crypto state, but definitely from a regulatory perspective, they've been early to the party, but the most restrictive and the most licensing requirements. So for over 7 years now, they have had the New York Department of Financial Services has been their regulatory oversight for New York's crypto market. They're known for their BIT license rules, which is involving comprehensive licensing and regulatory guidance for virtual currency firms in the space. It's not the most innovation friendly or business friendly, but it offers some guide rails in terms of what everybody knows they're operating by. This has chased away a few digital asset providers out of New York, but at the same time, there's so many people there, there's a lot of money, a lot of jobs, and it's growing faster in New York than some of the other states. And that's why they will proclaim themselves to be crypto capital in the US. California is also starting to head down this path as well. Another honorable mention is Wyoming. They are also in the race to establish themselves as a leader in the crypto space. Wyoming does not currently collect any personal or corporate income tax, but beyond that is also working to attract crypto traders and businesses by developing friendly regulatory frameworks for digital assets. The Wyoming state legislature enacted multiple blockchain-related laws, including a legal framework for recognizing decentralized autonomous organizations, or DAOs. Wyoming created a new type of charter, the Special Purpose Depository Institution, to focus on digital assets like virtual currencies, digital securities, and digital consumer assets. So it's also known as the Crypto Banking Charter. From what I understand, there's been a few companies that have applied for that charter. I'm not sure how far along they are with that. In my home state, we've got Florida. We are trying to position our state as not only the next cryptocurrency capital, but also the financial capital of the United States. I had the opportunity to go to Bitcoin 2022 earlier this year, where they unveiled the Miami Bull as a little jab to the Wall Street traditionalists, I suppose. But Florida is taking a lot of steps to be crypto friendly, most noticeably legislation to remedy the Espinoza problem, which is an individual who is actually charged for unlawfully engaging in money transfer laws. So in response to that, Florida's Office of Financial Regulation passed legislation and signed by the governor that created a legal distinction between two parties buying, selling, and trading cryptocurrencies versus transactions that were facilitated through third-party intermediaries. Those changes will come into effect in January of 2023. Florida and Colorado also accept crypto for state taxes, and the governor here in Florida also receives some or all of his pay in cryptocurrency as well. Texas recently, the state of Texas passed several bills to improve the regulatory framework for crypto, including a bill that recognizes the legal status of cryptocurrencies and paves the way for financial institutions to provide custody services for cryptocurrency. So they're really trying to appeal to this new industry. They're offering pro-crypto laws. They have low energy costs, tax credits, training, and other incentives to do crypto business in their state. So very pro-innovation in terms of state. When we talk about the most restrictive state, we talk about Hawaii. There are a couple of companies that have received the ability to work in Hawaii, but they're really more into more of a sandbox type of environment. Most digital asset companies are not allowed to do business there. Of course, the downside of this is little innovation or support for new businesses and jobs that are evolving with this space. Hawaii has historically excluded virtual currencies from their state Money Transmitter Act. The least restrictive, Indiana, Montana, and Massachusetts. These are a few of the states that have the least restrictions, but the downside of that is that there's some criticism around appropriate protection for consumers and businesses. So maybe not enough rules that they have in place. And the last one I'll mention in terms of specific states, just yesterday, the state of Washington came out with guidance on the tax treatment of NFTs. They will now apply a 6.5% sales and use tax retroactively to 2009. They already tax digital goods, digital codes, and digital automated services. So this industry continues to rapidly evolve. We see several signs suggesting state regulators will continue to play an active and key role in regulating the global industry, or global crypto industry. And again, hopefully they continue to focus on regulations to balance the needs of consumer protection, but also promote the innovation by keeping that regulatory burden to some sort of minimum and inspire the federal level to do the same. So let's hear from Larry on the federal landscape.
Thanks, Patty. So this will be some review for folks that are familiar with some of the federal requirements, but Bank Secrecy Act was from 1970 and obviously requires financial institutions to assist government agencies with detecting, preventing money laundering and terrorist financing. Specifically required to keep records of cash purchases, file those reports if the daily aggregate exceeds $10,000, and report suspicious activity. This would be through suspicious activity reports that may signify money laundering. Sometimes we could require, or we refer to BSA as BSA/AML. It's worth mentioning that regulators take BSA very seriously for both traditional finance and firms engaged in the digital asset business. Case in point, the Office of the Comptroller of Currency issued in April 2022 this year, 2 cease and desist orders, one against USA Federal Savings Bank and the other against Anchorage Digital Bank for violations of Bank Secrecy Act and deficiencies in their anti-money laundering programs. In the case of USAA, OCC issued a $60 million penalty. FinCEN, which also is another Treasury Department, applied an $80 million fine in addition to the OCC issuing a $60 million penalty. The order against Anchorage Digital Bank was based on the bank's failure to adopt and implement a compliance program that adequately covered BSA and AML requirements. Interestingly, Anchorage Digital Bank is the first federally chartered cryptocurrency-focused bank and was granted conditional approval by the OCC in January to convert from a traditional trust company. So again, AML considerations, obviously very important. A little bit more on AML. Obviously, there are a couple key areas of it. Certainly know your customer, so identifying and verifying customers' identity when opening the account. Customer due diligence, making sure that you've collected all the proper information on the customer's profile. Transaction screening as well. So things like you're not on the OFAC list or you're not dealing with a politically exposed person. And then I mentioned suspicious activity reporting, verifying large sums of money and reporting cash transactions exceeding an aggregate $10,000. So also another kind of requirement is around FinCEN. So this is another Treasury Department, so Financial Crimes Enforcement Network. And they analyze information about financial transactions to combat domestic and international money laundering. FinCEN does require and oversees kind of money service businesses at a federal level. And they also are a member of an international organization, which we'll touch on later, called the Egmont Group. While OCC or NCUA, so OCC being the bank regulator or NCUA being the credit union regulator, can issue fines for BSA AML violations. So can FinCEN, as was the case in the previous example with USAA being fined. FinCEN also requires MSBs to be registered with them. So how does FinCEN define money service business? Most importantly, it captures any transmitted value that substitutes for currency. And thus just about any crypto firm, since cryptocurrency would substitute for currency or digital assets could substitute for currency, any crypto firm would be required to be registered with FinCEN, and most of them certainly do. There are some exemptions. Banks don't have to register. Companies registered with SEC or CFTC and that are examined by them, or an actual person that conducts money service businesses on an infrequent basis and not for gain or profit. So there are some exemptions. So FinCEN is also responsible for enforcing the travel rule, and that falls under BSA. Reason for the travel rule is to block terrorist financing and money laundering. In 2019, FinCEN started requiring virtual asset service providers, so we'll call them VASPs, to report transaction deals greater than $1,000, and that's kind of on an international level. That's a FATA requirement, so that's Financial Action Task Force. Now those are recommendations, so FATA makes recommendations. They're an international body, so countries don't have to abide by them, but most of them certainly do. The U.S. has kind of different requirements than FATA, actually a little bit broad or a little less stringent. So in the U.S., FinCEN requires any transactions greater than 3,000 to be recorded. There are a lot of jurisdictions kind of internationally that aren't complying with this. Again, as FATA can only make recommendations to countries. So countries can either agree or disagree with those recommendations. Switzerland is known to have the strictest version of the travel rule, where regulators require identification of private wallets interacting with local VASPs. Fortunately, in the US, we don't have to do that. So things that you have to capture are identities of the originator and the beneficiary, when again, those transactions in the US are above $3,000. And then in 2020, the Federal Reserve and FinCEN issued a joint notice of proposed rulemaking, or an NPRM, soliciting public comment on some proposed amendments. We've not had any follow-up on those, so I don't think those are going to be enacted. But what they were looking to do is lower the requirement for collecting, retaining, transmitting information on funds or transfers from $3,000 to $250. So that obviously could be problematic. Complying with the FinCEN FATA rule really isn't that easy, as there's a need for interoperability communication system between various crypto exchanges, such that those virtual asset service providers can easily receive and send personalized identifying information, or PII. This means the entirety of the crypto industry really had to embrace a collaborative effort in developing communication standards. In response to that travel rule, the crypto industry has reached a consensus over a single data messaging format for all travel rule protocols. That format is called IVMS 101. So you can use that as kind of, use that at the next cocktail party you're at, throw that out. So let's next talk a little bit about OFAC. It's another office of the US Treasury. They are responsible for enforcing sanctions. OFAC sanctions apply equally to financial institutions as well as digital asset providers. Members of virtual currency industry are responsible for ensuring that they do not engage directly or indirectly in transactions prohibited by OFAC sanctions. So, that would be dealing with blocked persons or property, engaging in prohibitive trade or investment related transactions. OFAC does have a list of individuals that obviously aren't supposed to do business with, along with a list of countries. So that's OFAC, Office of Foreign Assets Control. Some other federal regulatory agencies are involved. So FDIC, one of the requirements of FDIC is if you are engaging in digital assets as, in this case, a bank, that you notify the FDIC of your intent and provide all necessary information to engage with that institution regarding related risks. You also encouraged to notify your state regulator. So if you're a bank, you have to notify FDIC if you want to engage in digital assets. Similarly, you have to also notify the OCC, and in that one, you actually have to get a permission or a non-objection letter from the OCC for you to engage in, again, digital assets. Make sure that you are conducting activity in a safe and sound manner, and that you've got the proper risk management practices in place. NCUA, obviously on the credit union side from a regulatory body, so they gave the okay to establish a relationship with third-party providers that offer digital asset services. This includes third-party providers that allow members to buy, sell, and hold uninsured digital assets with third-party providers. So that's an important designation, is those assets are uninsured, but NCUA does allow credit unions to engage in relationships with third-party providers to introduce digital asset solutions to the market. And then finally on this page, CFPB has said publicly that they intend to conduct examinations on fintech companies. I would take that to also mean digital asset companies, and hold them to the same standards that banks are held to. So a couple other federal agencies would be the SEC and CFTC. The SEC, there's been quite a bit of news about the SEC looking at digital assets and trying to decide, are these things securities? Do they fall under their purview? CFTC has been kind of looking at the same in terms of, are these things commodities? Do they fall under futures and derivatives trading? So far, the SEC has said publicly that Bitcoin is a commodity, is not a security. They've not said that the same about Ethereum. That one's kind of a little bit open still. I think both of them will probably ultimately be deemed commodities, but that's just an opinion, so certainly not legal advice. CFTC obviously governs commodities, future derivatives trading. Most cryptocurrency is not a commodity, meaning, like an example, sugar, oils, or metals. Bitcoin, again, is one of those ones that probably is. So it doesn't necessarily fall under their jurisdiction if it isn't. But there is a push in Congress right now to make the CFTC kind of the regulatory body for most digital assets. At the end of the day, I think there's some overlying jurisdiction. We probably expect that some digital assets will probably fall under securities and some will fall under, again, SEC, and some will fall under the CFTC as commodities. And over time, some of them, as they become more decentralized and don't have kind of a central organization running them, might look a lot more like commodities and could initially start out life as a security and ultimately end as a commodity. Recently, last month, the White House released its comprehensive framework for responsible development of digital assets. They solicited opinion from probably a dozen and a half multiple government agencies. I think 7 of them have gotten back with reports. Do expect more of those to come in the future. I think Department of Treasury, obviously U.S. Department of Treasury. I think Department of Justice weighed in. There's a couple of them. The report really, or the framework really focused on protecting consumers, investors, and businesses, which makes sense, right? Also promote access to safe and affordable financial services. I think that's going to be a big one. There's a big push for kind of financial services to be cheaper, less friction, more affordable, more transparent, certainly. And this administration is supporting that. Foster financial stability, which is makes sense. Advance responsible innovation, reinforce our global financial leadership and competitiveness. So increasingly, digital assets in the industry is seen as a competitive advantage for the U.S. And it's good to see that the White House is starting to recognize that. Of course, continue to fight illicit finance. And then lastly, explore a central bank digital currency. And that was really guidance to do more research on a central bank digital currency. The Federal Reserve is the one that would probably ultimately push for that, whether that's a wholesale or retail central bank digital currency, hard to tell. And then there's an open question as to whether or not the Federal Reserve needs approval from Congress to launch a central bank digital currency. I think they've said publicly they would like support of Congress, but I don't think they've ever been nailed down on saying that they have to have support of Congress. At the end of the day, I think we are going to see this continued evolution of money where everything becomes digital, and we are going to get either a central bank digital currency, leverage stable coins, and or private digital assets. But at any rate, we're starting to get some guidance around that and what the framework might look like. And then finally, here's some recent regulatory updates ranked by date. Biden administration in March issued a directive that was an executive order that kind of kicked off that White House directive that I just mentioned. OCC has issued a 4th interpretive letter. That was the one requiring letter of non-objection. But OCC's prior 3 letters were pretty supportive, allowing banks to run nodes and hold digital assets directly on their balance sheets. We saw recently New York Mellon offer custodial services for Bitcoin. President's Working Group, so that was a group of a number of federal agencies have gotten together to provide guidance to Congress, particularly around launching stablecoin legislation that we expect will happen sometime next year. NCUA, I already mentioned, provided direction to credit unions, allowing them to establish a relationship with third-party providers, also to engage with digital ledger technologies. We had a couple proposals through Congress. We had the Lummis-Gillibrand Responsible Financial Innovation Act, which really laid out a broad bipartisan bill. There was a whole wide range of regulations around digital assets, not specifically to stable coins, but all of them. We had last year at a state level, Department of Financial Services, New York Department of Financial Services, which was the first one to have kind of the BIT license. They've given some guidance around criteria for stable coins, actually matched up pretty nicely with the Lummis-Gillibrand bill. House Financial Services Committee introduced a bill, requirements for stablecoin issuers, addressing some ESG considerations. That's also something that kind of came out of the White House framework. And support for the Federal Reserve, and again, researching a digital dollar or central bank digital currency. The Stable Now, Bozeman and Thune Act, Digital Commodities Consumer Protection Act. That one would give, again, the CFTC, as I mentioned earlier, exclusive jurisdiction over digital commodity spot market. which is probably one of the reasons we don't have a spot ETF yet, although that really needs to be supported by the SEC. And then we already covered the comprehensive framework for responsible development of digital assets, which was issued in September. So next, we are going to cover regulations, enforcement, and compliance from an international point of view, and we will turn it over to Jesse.
Awesome. Thanks, Larry. So wanted to start by just kind of popping around, hitting some highlights about regulatory advances across the globe. I'll start in El Salvador, and this is probably the one most of you have heard of. That this made a lot of publicity last year when it occurred. So in September 2021, El Salvador began recognizing Bitcoin as legal tender. It's been an interesting journey for them. It's definitely had both ups and downs. I think the media typically focuses on a lot of the downs. And so you may have heard that that's been a failure. Admittedly, their rollout was far from smooth operationally. They had initially given all residents like $30 worth of Bitcoin, and there was a lot of fraud where people were accessing other people's wallets. And so a lot of people, by the time they set up that to claim their $30, someone else had already done so. But there's also definitely some positive that I don't think gets talked about nearly as much. And so in the last year, 2% of international remittances have gone through Bitcoin. This might not sound like a lot, but when you consider that Salvadorans spend about 400 million per year on remittance fees, and that's all coming from sending money back home to their family, every impact matters. And the amount of those remittances going through Bitcoin channels, so having far cheaper fees associated than anything that you would get through a MoneyGram or a Western Union, that's steadily been increasing month over month. And so, they're on track to hit 4% in year 2. And as that happens, that's really proving out to be one of the major use cases of why they made Bitcoin an official legal tender there. Jumping over to Canada, Canada probably has some of the strictest policies when it comes to crypto today. Larry was touching on whether cryptocurrency is regulated as a commodity or as a security. In the US, we're still figuring that out. In Canada today, all cryptocurrencies are regulated as securities. But again, I expect that could change once the USA makes that clear on our side. I think there's a good chance that Canada may follow suit. Again, just my personal take. Jumping over across the pond to the UK, the UK definitely aspires to be a crypto hub. They've been very active in regulating crypto, creating policy. Recently, a couple months ago, they actually took the rare action of peeling back a regulatory restriction that they had. So they had a restriction related to private non-custodial wallets. They thought that there was a chance that private non-custodial wallets were dangerous and associated with illicit activity. And so they had a bunch of rules related to that. They actually did a very large research project that showed the vast majority of private unhosted wallets were not, in fact, tied to illicit activity. And the UK Parliament recently rolled back some of those restrictions. Next, I want to jump over to the European Union. I believe it was in June, they passed the MiCA framework. MiCA stands for Markets in Crypto Assets. This is a very robust framework. It's really one of the most impressive pieces as far as far-reaching, all-inclusive digital asset policies that we've seen. It includes consumer protection, it includes AML, it includes regulations around stable coins and what sort of backing that stable coin needs to be, that needs to exist in order to call itself a stable coin and to be traded on various exchanges. So again, trying to prevent things like what we saw with Terra Luna, which was, again, an algorithmic stablecoin, not a stablecoin that's backed with real assets. And so the MiCA framework covers that. It also has service provider licensing included. There's a lot of things related to NFTs. And so I think it's really set a really strong framework that I think we'll see other countries follow as they come out with their regulation. And the last two countries I want to talk about today, I would consider these two of the most mature countries when it comes to the regulation of digital assets. And we see that, even though obviously on this visual, they're very tiny dots on the map. But the UAE and Dubai specifically really serves as a financial services hub for the Middle East and Africa. Most, international banks and Visa, for example, has their Middle East and Africa hub in Dubai, and they have their Asia hub in Singapore. Singapore serves as the financial services hub for all of Asia. And so starting with the UAE, they have established a regulatory body called VARA. And so VARA stands for the Virtual Assets Regulatory Authority. It's a regulatory body specifically focused on regulating digital assets or virtual assets, as they call them. Interestingly, they have a headquarters within the metaverse, specifically within the Sandbox metaverse. So people can stop by their headquarters virtually. They host office hours. People can come in the metaverse and talk policy with them and ask questions. Sort of practically what they've been focused on, they've been doing really good work of collaborating with the private sector in creating effective policies related to digital assets. They formed a lot of different working groups that are, mixing private sector with the regulatory bodies, really talking about what works and really focusing on, what they would call common sense regulation. Singapore similarly has been very focused and they've had, they actually passed the Payment Services Act 2.5 years ago, back in January of 2020, which contained some of the first crypto-specific regulation in the world. Recently, in August 2022, they passed sweeping consumer protection regulations related to retail investors. I actually recently had the opportunity to attend one of the largest digital asset conferences in the world. It's called Token 2049. It was hosted in Singapore. One of the speakers I attended had one of the MAS ministers. So the MAS is the I'm drawing a blank on what it stands for, but it's basically their main financial policy making hub. And so what he was speaking on was consumer protections. What I found interesting about the speech I heard from him, they're intentionally adding friction when it comes to retail investing of digital assets. And so that is in the name and the vein of consumer protection, really making sure the consumer knows what they're getting into. And so for retail investing, we're seeing more and more sort of consumer protection. It's kind of a good segue to the next slide. This slide, I'm not going to go around and talk about all of these. There's a lot of countries listed here. Again, I was just giving a snippet from a few that I found particularly interesting. But what this slide talks about, it's focused on protecting the consumer. And so the top box here that you see talks about where specific licenses are required. And you can see most of the countries have licensing in place. And then what I find really interesting is the bottom half of each of these boxes. You can see that every country represented here except Argentina actively has a central bank digital currency project going on. Most of these are not live yet. I think off the top of my head, the only one that is China. They have the digital renminbi, which is a digital version of their yuan. But it's really interesting to see just how many different central bank digital currency projects are going on. And so that's really sweeping, wide ranging. I think we're going to see more and more of that. And again, as we've talked about on some of the earlier webinars we've had, a bit controversial in the digital assets world. Kind of central bank digital currency is almost the antithesis of what Satoshi Nakamoto set out to achieve with Bitcoin. And so again, really interesting to see the direction that's going, with central banks establishing their own central bank currency projects. And honestly, what these look like is very wide ranging. So some of them are creating the equivalent of checking accounts for individual citizens with the central bank. Others are creating them as accounts that are just between the central banks and the individual banks. And so again, a very wide array, which kind of is a nice segue to the next few organizations I want to talk about. And so with all these countries building out their own regulation, all these countries doing things in a different way, having different viewpoints on what's a security, what's a commodity, how are we regulating this? There's a real need to have standardization across different regulations. And that's important because one of the main use cases of digital assets is how cross-border they are, right? The Bitcoin was intended to be a borderless currency. And so how is that going to exist when we have different countries regulating it in different ways? And so just want to talk about 4 different organizations that exist. Just give a high level of sort of what their mission statement is, what they're focused on. These are all international bodies that are working with the different governments of the world in order to create consistency when it comes to digital asset regulation. So the first is the FSB. The Financial Stability Board is an international body which was established after the 2019 G20 summit. The FSB monitors and makes recommendations about the global financial system. And they just recently came out with a very robust consultative document just this month, making suggestions on digital asset regulation. Again, one of their main goals is preventing regulatory arbitrage. If you're not familiar with that term, it basically means having conflicting regulations between countries, where it would be impossible for a company to offer a product that is compliant in 2 different countries because their regulations directly conflict with each other. So I'm not going to go through everything that document focused on, but again, it was focused on providing that guidance to regulators as they're crafting their policies. The next, we have the Bank for International Settlements. Their mission is to foster international monetary and financial cooperation. And really, they serve as the central bank for central banks. So they've had a lot of activity recently. Again, similar to the last one, talking about making recommendations. They actually work closely with the FSB. And so they're putting out guidance for central banks, for governments to consider, talking about the risks that exist for different assets, and really with the mindset of, if you have the same risks that apply, really all of these regulations should be tackling those risks in the same way. And so they're trying to provide that guidance. And then the final 2 groups I'll talk about today are the Egmont Group and the FATF. The Egmont Group is an international network of financial intelligence units. So notably in North America, this includes FinCEN in the USA and FinTrack in Canada. The goal of the Egmont Group is to fight against money laundering, terrorist financing, and other financial crimes. And then the FATF is an intergovernmental policymaking body whose purpose is to establish international standards and to develop and promote policies. So both of these groups coordinate in addressing money laundering risks and terrorist financing, and they're working on moving digital asset firms into the existing bank regulatory framework. In recent times, both of them have been very active, particularly since Russia invaded the Ukraine, and there's been a lot of concerns about money flowing to the Russian government. They were also involved recently in shutting down Tornado Cash, which made quite a bit of news. So if you weren't familiar with Tornado Cash, they were basically a virtual currency mixer, is how they described themselves, that theoretically disguised the identities of parties involved in transactions and money movement. But as with many things in blockchain, things that illicit actors often think are being done anonymously do have much more of a paper trail than is expected. And so investigators were ultimately able to determine that billions in funds had found their way to sanctioned individuals and countries. And as such, Tornado Cash was shut down. A lot of assets were seized, somewhat controversially, because plenty of people who were using Tornado Cash weren't necessarily involved in those illicit actors. There could be other legit reasons people wanted to disguise their identities from a privacy perspective. And so that's something that's going underway now is all of those assets that were tied up with Tornado Cash. People are trying to figure out which ones were rightfully seized because they were tied to illicit activity, and which ones need to go back to the rightful owners. So with that, that wraps up the international segment, and I'm going to pass it back to Larry to kind of wrap it up and talk key takeaways.
Thanks, Jesse. Before I talk about the key takeaways, I will share one more slide after this, which is some regulatory links. It's going to be hard to probably capture it, but if anyone needs access to those links, reach out to SRM and we'll be happy to provide those. So key takeaways from today really is that regulation enforcement compliance is shaping the digital asset space and really opening opportunities for traditional finance participation. We've got a number of existing clients that are looking to launch digital assets in this space. We know of probably 100, 150 others that are looking to launch digital assets to their customers or members. And so we continue to see that as an increasing direction. Regulation applies obviously to digital asset providers and financial institutions. So it's important as you pick a third-party provider to work with that those digital asset providers are complying by all the regulatory requirements that you have and that they may have that's unique to them. Compliance is largely dependent on the jurisdiction or jurisdictions that the financial institution or the digital asset provider is operating in. We obviously talked about state, federal, and international regulations. So in some cases, all three of those may apply for, say, a third party that might be operating in all of those. We mentioned that regulation is not yet consistent, really leading to regulatory arbitrage. And then, this is a complex area. Get help. Compliance isn't something that, particularly as it relates to digital assets, it is entirely clear. It's changing all the time. And so it's worthwhile having a partner that can help you with that. Certainly strategic resource management could be that partner. And then finally, I'll just share the the regulatory links. Again, a lot of these here will be useful. If anyone wants these, feel free to email us and we'll get those to you. With that, I'll hand it back to Neil, but want to thank everyone for your time and attention. I know this is a complex topic we really enjoyed talking about, and we appreciate everyone's attention. Neil, back to you.
Yeah, thanks, Larry. And I think what we'll do is we'll send these links over in our follow-up email as well with the recording of today's webinar for those who attended or those who were not able to attend. Larry, one question just kind of as a follow-up that came in. You'd mentioned obtaining the letter of non-objection from the OCC. Have you talked to anyone who's gone through this process or had any challenges with response, timing, kind of general friction acquiring that?
Yeah, so we've got some clients that are in that process. I don't know there's as much friction as I think there's a backlog with OCC. There's a lot of banks that got into this early prior to that fourth introductory letter from the acting deputy of the OCC, which kind of, there was full steam ahead up until the last one, which says, hey, you got to get the letter of non-objection, which is going to obviously require the OCC to look through that paperwork, make sure they have the proper risk management policies and procedures in place. And I just think they probably weren't expecting as many banks that had filed for that. So I think there is a little bit of a backlog. I imagine they will get through that. And we'll see a number of banks launch solutions in the near future, including some that are our clients.
Larry, what I'll add to that is, another thing that we've heard is that while the FDIC and OCC have given guidance at kind of the, coming from the top at the federal level, the ways that guidance has kind of been trickled down to the local regulators that are in the local jurisdictions has been somewhat inconsistent from what we've heard. And so and that's to be expected. It's early days still. But it's something where we've seen a little bit of inconsistency with at the local level, how strict and how rigid are those letters of non-objection to come by.
Yeah, and to that point, Jesse, one of those links on there is that OCC recently announced their 2023 supervision operating plan. So for the upcoming year, and that's the guidance for their examinators to work with third-party, to work with banks and examining some of those third-party relationships. What it basically said is that you needed to do the proper due diligence on those third-party providers and treat them with a lot more skepticism than, say, just kind of your standard fintech relationship or your standard third-party relationship. And which I think is important, because what we suspect will ultimately happen is, if someone went out there and just selected a provider because they happened to hear the name, or they didn't really do that much due diligence and look at a number of different solutions and have a good, credible reason why they went with one particular provider versus another, I think that OCC might come down hard on them. So we're encouraging people to do a full due diligence of all of the providers on the market and make sure that they pick one that's right for their customer or member base.
And to also challenge, because this integration often happens within the space of your core or your online banking providers. And so on those same lines, there might be providers that they've already started working with that are encouraging the institutions to look at. But again, the examiners might say, why did you choose this one? And it might not be the right answer to say, well, that's who our core told us to do. You're still going to want to do your due diligence. And the challenge that we find too is our clients don't even know what questions to be asking, what they need to be looking for. And so there's a lot of things that fall into that category as well.
Excellent. Well, thank you all for providing the insights today and answering those questions. And just thanks to everybody for spending the Friday afternoon with us. I know there's a lot that can happen towards the end of the week, so we appreciate your time. We hope this was educational, it was insightful. And as always, keep an eye out for more programming ahead. We know this space continues to evolve at a breakneck pace, so we'll continue to follow it and provide the best contextual information that we can at the time. So keep an eye out for a follow-up email with the recording of today's webinar. And as I mentioned, these links as a resource. And then if you do have any follow-up questions, or you want to talk more about your company's plans, their needs, you can reach out to Larry, Patty, Jesse, your SRM contact. We'll be happy to help and get that conversation going. So otherwise, I'd say probably wrapped up here, and just have a wonderful day and a wonderful weekend. And thanks for joining us today. We appreciate it.
Thanks, everyone.
Take care.
Thanks, folks. Bye now.